Have you been wondering how you can make your money work for you? Then stick around because in this video, we're going to explore some investment strategies that will help you achieve this. We'll also look at how you can get started on these investment journeys. Whether you're a beginner or looking to level up your investing game, this video has got you covered. With that said, let's jump right in. Now, investment strategies are plans that help you decide where and how to invest your money. It depends on things like how much you want to make, how comfortable you are with taking risks, how much money you have, how long you want to invest, when you plan to retire, and what industries you like. You can make your investment plan based on what you want to achieve. With that said, let's talk about some of these investment strategies step by step. Number 1. Growth investing. Investors pick how long they want to hold their investments, which could be short-term or long-term, based on what they want to achieve. If they think a company will grow in the future and its stock price will go up, they'll invest in it to make more money over time. This is called growth investing. But if they believe a company will do well in just a year or two, they'll go for short-term holding. How long they hold also depends on what they need the money for, like buying a house, paying for their kids' education, or saving for retirement. Here are some ways anyone can invest in both short-term and long-term investments. Short-term investments. One of the safest short-term investments is a high-yield savings account. These accounts offer a higher interest rate than regular savings accounts, allowing your money to grow slowly with minimal risk. You also have certificates of deposit or CDs. CDs are time deposits with fixed term and interest rates. They typically offer higher interest rates than regular savings accounts, but your money is locked in for a specific period, ranging from a few months to several years. Other ways include money market funds, treasury bills, corporate bonds, and so on. Long-term investments. Now, investing in individual stocks or exchange-traded funds, that's ETFs, provides the opportunity for long-term capital appreciation. Stocks represent ownership in a company and their value can fluctuate significantly. Also, government bonds like US Treasuries and corporate bonds with longer maturities can offer stable income and capital preservation over the long term. We also have real estate. You see, investing in physical real estate properties or real estate investment trusts can provide rental income and potential property value appreciation over time. Other long-term investments include mutual funds, retirement account dividend stock, and so on. Number 2. Income investing. Income investing, sometimes known as dividend investing, is a strategy that focuses on generating a consistent stream of income from your investments rather than solely aiming for capital appreciation. This approach provides you with two primary sources of income: dividends from stocks and fixed interest payments from bonds. When it comes to stocks, income investors look for companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These dividends can provide a reliable source of cash flow, which can be especially appealing to those seeking regular income to cover expenses or enjoy the fruits of their investments. Additionally, income investors often include bonds in their portfolios, as bonds offer predictable interest payments over time. This strategy is particularly well suited for individuals who value a dependable and steady income stream, making it a smart choice for retirees or anyone looking to supplement their regular earnings with investment income. Number 3. Passive and active strategies. The passive strategy, often called a buy and hold approach, means you buy stocks and keep them for a long time to avoid frequent trading fees. People who like this approach believe it's hard to consistently do better than the overall market because it goes up and down a lot. So they choose to be patient and believe that over time, the market generally goes up, leading to steady growth. This set-it-and-forget-it mindset is seen as a less risky one because it avoids the daily ups and downs of the market, making for a more relaxed investment experience. On the other hand, active strategies involve a dynamic approach where investors often buy and sell assets, trying to beat the average market performance. People who use this strategy are confident in their ability to take advantage of market changes by making timely trades, aiming to make more money. They pay close attention to market trends, economic signs, and how companies are doing, using this information to decide when to buy or sell. The active approach means being ready to quickly adjust to changing market conditions, possibly benefiting from short-term opportunities. Number 4. Value investing. Value investing is a proven way to invest money wisely. It's about spotting companies whose stock prices seem lower than what they're actually worth. Think of it as finding hidden gems. These companies are often overlooked because everyone is focused on trendy stocks. Value investors believe that sometimes the market gets it wrong, underpricing good companies due to temporary problems, bad news, or other reasons. The main idea behind value investing is to buy these undervalued gems when they're selling for less than they should, which is called their intrinsic value. Intrinsic value is the real worth of a stock based on the company's financial health, potential to make money, and other important factors, rather than just following the crowd. Value investors patiently hang onto these stocks thinking that eventually the market will realize how valuable they are. When the market catches up and reevaluates these undervalued companies, their stock prices are expected to go up. That's when investors can sell and make a profit. This strategy is famous for working well in the long run and is closely associated with Warren Buffett, a legendary investor. Buffett has become incredibly rich and famous by being really good at finding undervalued companies, waiting patiently for the market to see their true value, and then reaping the rewards. Value investing, although it requires patience and self-control, has proven to be a dependable way for people to make good returns without consistently guessing what the market will do next. Number 5. Indexing. Indexing is a smart way to invest your money across a wide variety of stocks without having to choose specific companies. Imagine you want to put your money into the stock market, but you're unsure which particular companies to pick. That's where indexing comes into play. Instead of handpicking stocks, you can invest in something known as an index. Think of an index as a bundle that contains many different stocks all in one package. A well-known example of an index is the S&P 500. This index comprises 500 of the largest and most established companies in the United States. When you invest in the S&P 500 index, you're essentially purchasing a small share of each of these 500 companies. But it's not just limited to the S&P 500. You can also invest in indexes through mutual funds or exchange-traded funds. Mutual funds and ETFs are like baskets that hold a mix of stocks, bonds, or other assets, and they often mirror the performance of a specific index. So when you opt for indexing, you're spreading your money across a wide range of companies or assets. This can help lower the risks that come with investing in individual stocks. Many investors prefer this strategy because it focuses on the long-term growth potential of the overall market rather than trying to guess which individual stocks will do the best. Indexing simplifies investing, making it easier for those who don't want to spend hours researching individual companies. Instead, you can invest in the broader market's growth and potentially enjoy the advantages of a diversified and well-balanced investment portfolio. Now, here are some tips for new investors to keep in mind. As a new investor, you need to start by figuring out what you want to do with your money in the future. Whether you're saving for retirement, buying a house, paying for your kids' education, or something else, knowing your goals helps you decide if you should invest for the long haul or the short term and what kind of profits you want to aim for. It's important to understand how the stock market works and get familiar with different investment choices like stocks, bonds, mutual funds, and more. Also, keep an eye on the prices and returns of the stocks you're interested in. This can give you useful information about how well they're doing and what they might do in the future. The key to lowering the risk of your investment mix is diversification. Instead of putting all your money into one type of investment, think about spreading it out over a mix of assets that match your financial goals. A well-balanced mix tries to make you money while also playing it safe. Know how much risk you're comfortable with, which depends on what you want to achieve in the short term and the long term. If you're planning for the long run, you might be okay with taking on more risk in the hopes of getting bigger profits. But if you have more immediate goals, it's smart to choose investments with lower risk. When you diversify, make sure the different kinds of investments in your mix aren't too much alike. Having a variety of assets like debt, stocks, and other stuff that don't all act the same way when the market changes can help spread out the risk and make you mix stronger. Remember, the best investment plans help you make more money and reduce your risk. Your plan depends on what you want from your investments, how much risk you're okay with, and how much you want to be involved in picking investments. Many investors mix different plans to find the one that works best for them. Alright guys, that wraps up our video for today. If you enjoyed this video, please give it a thumbs up and don't forget to hit the subscribe button for more.